Hi guys, welcome to our third office hours. This is September 24th, 2024. We're going to talk about taxes. I know it's an exciting thing, and the question is, why in the world would we be talking about taxes in September? So we're going to just kind of jump right in and address that and a bunch of other concerns and issues that I get asked all the time when it comes to tax planning. So here are 9 year-end tax moves that you can make to take advantage of some opportunities. And kind of the reason we're doing this right now, this time of year, the time is running out. The clock is ticking. There are certain things that you're going to want to do during the calendar year of 2024 that will impact your 2024 taxes when you go to file in February, March, April of next year, or even if you delay and file later. There's still moves that you may want to make now. So time is running out. Let's address it. Let's jump in and keep this moving. One thing, maximizing your retirement contributions. There are some retirement contributions that you can make just prior to filing your taxes. So contributions to your IRA or Roth IRA, you don't need to file those or make those contributions until you file your taxes or April 15th. You just need to know what those contributions are and have made them prior to that April 15th deadline when you file your taxes. There are, however, some contributions that you need to make during the calendar year, specifically contributions in your employer retirement plans. So if you're at a 401k, 403b, you can set aside up to $23,000 in a salary deferral, either pre-tax or as a Roth contribution, but that needs to be done during the calendar year. So kind of laying that out over the next 3 months to say, okay, here's where I'm at year to date. This is what I need to do to maximize those contributions so I can set aside as much as possible. $23,000 if you're under the age of 50, then you get some catch-up provisions if you're over the age of 50 for another $7,500. IRAs, Roth IRAs. Contributions for IRAs and Roth IRAs need to be done simply prior to filing your taxes. $7,000 can be put into an IRA or Roth IRA. Over 50, $8,000 is available. And then there are other contributions for those of you who have different employer plans, like a simple plan. Same thing, the contributions need to be made during the calendar year as a salary deferral from your paycheck on your 2024 paychecks to make that contribution work. We're not going to talk about defined contribution plans in this presentation. We'll dive deeper into those later. Other things to be done during the tax year, harvesting tax losses. So for those of you who we manage accounts for, we try and be as tax efficient as possible. That's one way that we make retirement accounts or investment accounts more efficient, is by harvesting tax losses and offsetting gains as we do so. So there may be years where the market's down, and those might be perfect times to harvest tax losses so that in future years we can offset gains. Now you can write off and offset gains 100%, but only carry $3,000 more than the losses that you had and on this year's tax returns. All other losses would be carried forward, but they can be carried forward indefinitely until you have gains that would offset those. So we're always constantly doing that for our clients, looking at opportunities to become more tax efficient, but evaluating where you are and whether or not it makes sense to hire tax or to harvest tax losses could be a big decision. Consider converting Roth to Roth IRAs. Okay, love this picture. Before converting, actually, I think these might need to be swapped because that one looks pretty mean, pretty impressive. Jason Momoa there. Why would you convert to a Roth, right? So an IRA, a traditional retirement account, defers taxes when you defer those dollars into there, and it reduces your taxes in the year that you make that deferral. But a Roth IRA doesn't have any tax benefit the year you make those contributions, but you never have to pay taxes on those dollars, either the dollars that are in there or the growth on those dollars ever again. So one of the things we're talking to a lot of clients right now about is the Tax Cut and Jobs Act is sunsetting in 2026, which means taxes for 2024 and 2025, the tax rates are lower than they're expected to be in 2026 unless some legislation comes through, which means 22% tax bracket and 24% tax bracket, which is kind of the mid-range brackets where a lot of our clients fall. are going to increase. It might make sense to evaluate and convert a portion of or all of an IRA to a Roth IRA, pay those lower taxes, that 22 or 24% tax rate, or lower, 12, 10, whatever it may be, and then set that money aside in a Roth IRA that you never have to worry about taxes again. A lot of people would say that taxes are, I mean, right now we're expecting them to go up in 2026, could go up even higher. After that, we don't know. So a lot of people are saying, hey, 22%, 24%, that's a good place to be right now. I'll take that tax bill today, knowing what it's going to be instead of this variable down the road that I don't know, and it's expected to be higher. So look at potentially consider a Roth IRA conversion. If you have questions on that, talk to your financial professional. Utilize tax advantage accounts. I love this photo, right? So there are certain accounts that have different tax advantages. We've talked about an IRA and a Roth IRA just a little bit. IRA, you get a deduction for putting money in. Same thing with a traditional 401k, 403b, SEP, simple. Roth IRA or Roth 401k, you get zero tax deductions now, but it grows tax-free and you can access that money tax-free during retirement, okay? My favorite tax advantaged account is actually an HSA. It has benefits or the best aspects of both. You get a deduction for putting money into your HSA as long as you're on a high deductible health plan, right? Something that qualifies to allow you to do an HSA. You put money in there for a family, it's 73,000 or 7,300 and change, individual 34, 3,500. You can set money in, get a deduction for it. That money can be invested and grow and not pay taxes on that growth, and you get to pull it out tax-free as long as it's pulled out for qualified medical expenses. And you'd be surprised how many things qualify for qualified medical expenses. Not only that, but during retirement, one of your biggest expenses tends to be medical. So having a nice chunk in an HSA means you avoided paying taxes putting it in, you didn't have to pay taxes paying it out, and your medical bills then become tax-free during retirement as you grow that account. Another thing to do during the calendar year, reviewing your charitable contributions. There are different ways to make charitable contributions or stack charitable contributions that might give you a greater deduction than simply your standard deduction would, right? Some of you maybe have mortgage interest that you're writing off, you make charitable contributions, and that mortgage interest and charitable contributions still is less than your standard deduction, right? Well, what if you could stack 2 years worth of charitable contributions, or 4 years, or 5 years, or 10 years, or the rest of your retirement worth of charitable contributions and offset income in one given year? Charitable contributions, some of the availability to do those are going to be changing with it sunsetting the Tax Cut and Job Act. So there's benefit this year and next year, especially in looking at your charitable giving planning and doing some strategic moves during the calendar year 2024, 2025. Planning for required minimum distributions. This is another big one that has to be done during the calendar year. So those of you who are in that age range, above 73, where you have to take required minimum distributions, this is a huge penalty for those who don't take those distributions. So if you set money aside in a qualified retirement plan, 401k, 403b, IRA, and you're over the age of 73, you have to take some money from that account. Regardless of whether or not you need it or want to take it, you're going to be required to do that. And there's a big penalty of 50% of what you should have taken out, you have to pay in taxes. So if your account's $140,000 and you've got to pull $7,000 out, $6,500 out to meet that required minimum distribution, if you don't do that, you're going to have a $3,500 tax bill coming. So take that money out, make sure that you're meeting your required minimum distributions on all qualified accounts for those of you who are at the age where required minimum distributions are part of what you're doing. You can also level those up with the charitable giving and donate directly from your IRAs or 401ks. Other things to deal with, evaluate estate planning strategies. One of the things that's happening with the Tax Cut and Job Act is some of the changes in estate taxes and gift taxes that are going to be happening if that tax law actually sunsets. So time to sit down with your accountant, time to sit down with your attorney to do some estate planning and say, hey, with this change in the gift tax, with this change in the estate tax limits and exclusions, does that affect me? Are there some plans? Are there some things that I need to do strategically today to take advantage of the current laws that are going to be sunsetting? Another thing to do, review your withholding and estimated taxes. I don't know how many times I've had clients in April mad at their accountants that they have to pay taxes and they think it's the accountant's fault, okay? The ideal scenario is actually you get no return, you owe no dollars, and you're exactly on the money with how much taxes has been withheld or that you've been paying in quarterly tax payments. Make sure that your estimated taxes are on target, right? If you're putting more money in, I have some people say, oh, it's a forced savings. Just save. Let's set up the automatic contribution into an investment account that could have been earning money all year long instead of getting a return in April or waiting for the IRS, right? So look at your withholdings, estimate your taxes, try and dial those in. You have enough time during the rest of the month. What if I could say, hey, you've overpaid already in your taxes. You don't need to pay any more taxes for the next 3 months. If that's your scenario, there's 3 months where you had an increase in paychecks right around the holidays, or that you could jumpstart your savings plan and some of your goals for next year. We're going to be talking about some strategic goals and values in the next couple office hours. Consult with a tax professional. Guys, there is a certain point in which TurboTax just doesn't cut it, right? Consulting with a tax professional, having a relationship with a tax professional can save you thousands of dollars, tens of thousands of dollars, hundreds of thousands of dollars in strategic tax planning and taking advantage of opportunities in the tax code that are written there for our benefit if we know where they're at and to take advantage of. So have a relationship with a tax professional. If you need one, a referral to one, we work with some great tax professionals in the industry that we can connect you with that can save you thousands of dollars. One thing I like to tell people is, listen, there may be years where you're overpaying your accountant. Granted, like sometimes the job is easy. Hopefully none of the accountants that we work with are watching this. Sometimes the job is easy. It's kind of a layup, your tax returns are. But having that relationship, having that tax history recorded, having the ability to say, hey, this year we need to do this, that year where they make that strategic recommendation they could be woefully underpaid and actually make up for any years where you think you may have overpaid that tax professional, right? Professionals are there to provide value in the expertise that they focus on, and a tax professional is no different. So consult with a tax professional. Here's the disclosures. It's got to be part of every one of our presentations. So once again, if you've got questions, seek to talk to your advisor, seek to talk to a professional about your specific situation, but don't kick the can down the road when it comes to some tax planning, when it comes to some opportunities where you could take advantage of minor moves today that could save you a bunch of money in April when you're filing your taxes and you figure those things out a little too late. So hope you guys are doing well. We're going to stick around, answer any questions specific to those who are in on the call today. Thank you for joining us live, and we'll stop the recording at this point. We'll see you guys next time.